Alberta independence gets dismissed a lot. It gets called fringe. It gets called emotional. It gets filed under Western alienation and treated like a frustration that flares up every decade and goes nowhere. But here's what doesn't get asked often enough. What do the numbers actually say? Welcome to the Daily Brief Canadian Macro Weekend Edition. I'm Steve. Today we are sharing our own take on the Alberta independence question. We're not doing the cultural version of this conversation. We're not talking about identity or what it means to be Albertan versus Canadian, or the history of grievance politics in the West. Those are real conversations, just not this one. Today we're treating Alberta independence the way we'd treat any other major financial and structural question. Alberta is the entity, independence is the transaction. What does it cost? What does it generate? And does it pencil out? Let's get into it. Before you can evaluate independence as a proposition, you need to understand what we're working with. So let's start with the balance sheet. Alberta's GDP in 2024 was approximately $500 billion Canadian dollars, around $500 billion in nominal terms. The province grew at 3% in real terms that year, faster than Ontario, BC, and Quebec, and well above the national average of 1.6%. Alberta holds the highest real per capita GDP of any province in Canada, sitting roughly 26% above the national average, with per capita GDP around $71,000 Canadian. Now put that number on a world map. Finland, sovereign nation, NATO member, EU member, considered one of the world's most stable and successful economies, had a GDP of approximately $299 billion in 2024, with a population of 5.6 million. Norway, sovereign nation, widely held as the gold standard for resource wealth management, had a GDP of approximately $484 billion with a population of 5.6 million. New Zealand, yet another country nobody seriously questions the legitimacy of, had a GDP of roughly $250 billion with a population of 5.1 million. Alberta has a GDP comparable to Norway, with a population of approximately 4.7 million people. The size argument against Alberta independence doesn't hold on paper on the two most fundamental metrics of national viability, economic output and population. Alberta sits squarely within the range of successful, prosperous sovereign nations. That's the starting point. But size is just the entry ticket. What makes the independence question genuinely interesting is what's underneath Alberta, and this is where most of the independence debate undersells itself badly, because it focuses mostly on oil. So let's do what the debate usually doesn't, and actually look at the full resource picture. With oil, yes, we start here, because the scale demands it. Alberta's oil sands contain approximately 165 billion barrels of proven recoverable reserves, the fourth largest on the earth, behind only Venezuela, Saudi Arabia, and Iran. In 2024, Alberta produced around 3.5 million barrels per day, and at current production rates, those reserves last over 130 years. The total value of Alberta's energy production in 2024 was $139 billion, the second highest on record after 2022's exceptional $167 billion. Bitumen alone accounted for nearly $96 billion of that. Natural gas. This is the part of the story that almost nobody tells properly, and it deserves real attention. In 2024, Alberta produced 11.2 billion cubic feet of natural gas per day, the highest level since 2010 and roughly 60% of Canada's total national output. That's not a secondary resource. That is a top-tier national energy asset. And the reserves picture just got dramatically larger. A 2024 reassessment of Alberta's Montney, Duvernay, and Spirit River formations found reserves so substantial that Canada, which means largely Alberta, leapt from 15th to 9th globally in proven natural gas reserves almost overnight. The Montney formation alone assessed at 64.5 trillion cubic feet of unconventional gas. Natural gas liquids, propane, butane, ethane, generated an additional $19.7 billion in production value in 2024 on their own. This is not a province with an oil problem, it is a province with a hydrocarbon endowment that most sovereign nations would not believe possible. Agriculture. Alberta holds more than 49 million acres of farmland, 32% of Canada's total farm area. It's the largest beef producer in Canada, the largest barley producer, and the second largest producer of both wheat and canola after Saskatchewan. Farm cash receipts in 2024 came in at approximately $23 billion. Agri-food exports in 2023 set a fourth consecutive record at $17.9 billion, and the crop sector contributes around $20 billion to Canadian GDP annually. Here's a number that puts it in perspective. If you strip oil and gas out of Alberta's total exports, agriculture accounts for 38% of what remains. That is not a rounding error. That is a pillar industry, and independent Alberta is not dependent on oil gas price cycles for its food economy. It's a significant global agricultural exporter in its own right, selling into 70 plus countries worldwide. Minerals and critical resources. Alberta's non-energy mineral picture is at an early stage, but strategically important and developing quickly. The province holds identified lithium deposits in formation brines in west central Alberta, with E3 lithium alone reporting an indicated measured resource of 16 million tons of lithium carbonate equivalent in one district. Lithium is the critical mineral at the center of the global battery and electric vehicle supply chain, and demand projections are enormous. Alberta also has uranium potential in the south and northeast, potash potential along the Saskatchewan border, helium being actively extracted in the southeast. Helium is on Canada's critical mineral list due to its role in medical imaging, industrial manufacturing, and defense applications, and vanadium and rare earth elements being identified as byproducts of oil sands waste streams. None of these are yet at the scale of Saskatchewan's potash or Ontario's gold, but the geological foundation is being mapped, and the regulatory framework for mineral development only received its full legislative structure in 2024. The development curve is early, which in resource terms means upside, not limitation. An independent Alberta would own that upside entirely. Fresh water. This one is almost never mentioned in the independence debate, and it deserves to be, because water is increasingly understood as the strategic resource of the coming century. Canada holds approximately 20% of the world's fresh water. Alberta itself holds approximately 2.2% of Canada's share. For a province of 4.7 million people, that is a meaningful per capita endowment, and northern Alberta in particular has large river systems and significant groundwater reserves. What makes Alberta's water position particularly interesting is productivity. Alberta supports nearly 3/4 of all irrigation in Canada despite holding only 2.2% of the country's water. That ratio tells you something important about how efficiently Alberta converts its water resources into agricultural output. Former Premier Peter Lougheed said it plainly back in 2005, "Fresh water is more valuable than crude oil." That was a provocation at the time. It is starting to look prophetic. When you put all this together, the resource base of an independent Alberta is not an oil economy with some farms attached. It is a diversified resource economy anchored by an extraordinary hydrocarbon endowment, backed by one of Canada's largest agricultural sectors, early in the development of a critical minerals profile that aligns directly where global industry demand is heading, and holding freshwater access in a world that is pricing that resource more seriously every decade. The total value of Alberta's energy production alone was $139 billion in 2024. Add agriculture's $23 billion in farm receipts, $17.9 billion in agri-food exports, and an emerging minerals sector, and the resource revenue base of an independent Alberta is broad enough to weather oil price cycles in a way a pure petro-state could not. Norway, the country this debate always turns to, built its sovereign wealth fund on oil and gas alone. An independent Alberta would be building its national wealth on oil, gas, natural gas, agriculture, water, and a critical minerals pipeline. That is a more diversified starting point than Norway had. Keep that in mind as we stress test the comparison directly. Before we get to the Norway comparison, we need to establish the fiscal grievance, because it is the engine behind this entire conversation and the numbers are not in dispute. Every year, Albertans send roughly $20 billion more to Ottawa in federal taxes than they receive back in federal spending and programs. Since the year 2000, the cumulative net transfer out of Alberta is estimated at $554 billion. That's not just equalization. That's the full picture of federal revenue extracted from Alberta, minus federal dollars returned across all programs. Alberta receives zero equalization payments, one of only 3 provinces in that position, and in 2025-2026 receives approximately $9.2 billion in health and social transfers, which is the only major category of federal money flowing back into the province. For context, Quebec receives $13.6 billion in equalization payments alone in the same period, on top of its own health and social transfers. Whether that fiscal imbalance justifies independence is a separate question. The math is what it is. The Norway comparison is the separatist movement's favorite argument, and critics love to dismantle it. The interesting thing is that both sides are partially right, and the key to understanding why comes down to one variable that almost never gets discussed properly, which is timeline. Let's go through the 3 main criticisms of the Norway comparison and see whether they actually hold. Norway is in NATO, Alberta isn't, and starting from zero on security is disqualifying. This is worth examining carefully. NATO's central test in 2026 is whether members are willing to meet the 2% of GDP defense spending threshold. Canada currently spends approximately 1.37% of GDP on defense, one of the alliance's most consistent underperformers. An independent Alberta, committing on day one to meet or exceed that 2% threshold, backed by an economy the size of Norway's and a resource endowment that the United States cares about enormously, would be presenting a stronger membership application than Canada itself currently deserves by its own metrics. The geopolitical context matters here too. NATO is under pressure to add capable, committed, resource-secure partners in stable democratic jurisdictions. Alberta, sitting in the heart of North America, with the fourth largest oil reserves on Earth and demonstrated capacity to fund defense meaningfully, is not an obvious candidate for rejection. The security argument against independence is weaker than it first appears, particularly on a phased timeline where NATO candidacy is pursued from year one. The idea that Alberta would need its own currency from day one is a misconception, and the argument for using the US dollar runs considerably deeper than it's usually presented. The practical answer for an independent Alberta is dollarization, adopting the US dollar as the national currency from the outset, the way Panama has operated for over a century. The US dollar gives you immediate price stability, access to the deepest bond market on Earth, and seamless trade continuity with a country already purchasing the vast majority of Alberta's energy exports. But here's the dimension that rarely gets discussed. For a resource exporting economy, US dollar adoption in the early years of independence is not just politically convenient, it's economically protective. Think about what happens to smaller independent nations that maintain their own currency and face a commodity price downturn. Their currency falls against the US dollar at exactly the wrong moment, making energy imports, industrial inputs, agricultural machinery, fertilizer, and virtually every other dollar-denominated input more expensive simultaneously. They get squeezed from both sides. Revenue falls while input costs rise, and the currency market amplifies the pain. This is the resource-cursed dynamic that has damaged economies from Venezuela to Nigeria to smaller petro-states repeatedly. An independent Alberta adopting the USD avoids this entirely in the transition period. When oil prices fall, Alberta's revenues fall, but there is no currency depreciation simultaneously, making every import more expensive, because Alberta is already in dollars. The economy still feels the downturn, but it doesn't get punched twice, and when oil prices rise, the fiscal surplus accrues directly, without being partially eroded by currency appreciation, making exports more expensive in trading partners' terms. For a young economy trying to build a heritage fund, stabilize public finances, and establish fiscal credibility, doing all of that inside the US dollar means competing on fundamentals rather than on monetary credibility that hasn't had time to be earned yet. A made-in-Alberta dollar is then a deliberate, well-sequenced choice made from a position of strength, not a crisis response. You build the reserve base, grow the heritage fund, develop a bond market, and at some point monetary independence becomes a considered option, rather than a risk. This is probably the most important number in the whole conversation, so let's sit with it carefully. Norway's government pension fund Global is worth approximately $1 trillion today. Alberta's Heritage Savings Trust Fund is worth approximately $24 billion. Both funds were established in the mid-70s, both were seeded with oil royalty revenue. The resource endowments are comparable in scale. The gap between $24 billion and $1.7 trillion is not geology. It's governance, and specifically it is the position of who controlled the revenue and what it was spent on. Norway ring-fenced its own wealth through strict rules that prevented government from spending more than 3% of the fund annually. Alberta, meanwhile, was directing its surplus into general revenue, funding equalization contributions, and expanding political services, rather than saving. The Heritage Fund was effectively capped and left to stagnate for decades. Now, is that Alberta's fault, or is it a consequence of being inside a federal system that extracted Alberta's fiscal surplus? The answer, honestly, is both. Alberta governments made spending choices they didn't have to make, but they were also operating inside a fiscal framework that structurally reduced the capital available for long-term saving. The critical point for the independence analysis is this: an independent Alberta, with full control over royalty rates and zero equalization obligation, has a clear arithmetic path toward Norwegian scale wealth accumulation over a generation. The heritage gap is not evidence that Alberta can't manage its own money. It is the central exhibit in the argument that Alberta has never been given the conditions in which to find out. It is the central exhibit in the argument that Alberta has never been given the conditions in which to find out. The transition. What does it actually cost? This is where the conversation gets serious, because the viability question isn't really whether Alberta has the economic mass to be a sovereign country. The numbers in Part 1 say it does. The real question is what the transition costs, who bears it, and over what time frame. Let's go through the major line items. At 2% of GDP, the NATO floor, a fully stood-up Alberta defense budget would be approximately $10 billion per year at current economic size. That sounds significant until you consider two things. First, Alberta is already contributing to Canadian defense spending through federal taxes and receiving back a defense posture that chronically underspends and has struggled with readiness for years. The net cost of transition is not $10 billion from zero. It's the difference between what Alberta currently contributes federally and what it would spend independently, applied to a realistic build-out schedule. Second, this is not a day-one event. A realistic 10-year ramp involves negotiating a proportional share of existing Canadian Forces assets, equipment, and bases already on Alberta soil, then building out incrementally from there. Day one requires functional border security and an air patrol capability. It does not require a Navy, an Arctic defense posture, or a full expeditionary force. Those come in year 5 and beyond, on a schedule that fiscal reality can absorb. The NATO pathway, as we discussed, provides both security cover during the transition and a clear target to build toward. The CPP piece is one of the most analytically interesting parts of this whole conversation, and the range of estimates is large enough that we need to be precise about what we know and what we don't. Alberta's government commissioned an analysis in 2023 suggesting it would be entitled to approximately 53% of total CPP assets upon withdrawal, roughly $334 billion. The argument is that Alberta has historically punched above its weight in CPP contributions due to its younger, higher-earning workforce, and that the accumulated investment returns on those contributions belong to Alberta proportionally. In December 2024, Canada's federal chief actuary pushed back significantly, concluding that Alberta's entitlement is closer to 20 to 25% of assets, somewhere in the range of $100 to $130 billion. The methodology dispute is technical but consequential. It turns on how you apportion decades of investment returns between contributing provinces. The negotiated reality will land somewhere in that range, and it will be contested. But here's the structural point that gets lost in the asset dispute. Exiting CPP contributors do not lose their entitlements. The obligations follow the individual. People who paid and keep their benefits regardless of which government administers them. New workers entering the Alberta labour market begin contributing to an Alberta pension plan instead, and the transition phases in naturally over a working generation. Even at the lower federal estimates of $100 to $130 billion, you are seeding a new pension plan with a substantial asset base on day one. Independent analysis suggests an APP could operate at a contribution rate lower than CPP's current 9.9%, even with the conservative asset transfer, though investment performance risk is real, and CPP investment track record of approximately 10% annualized returns over the past decade would be difficult to replicate immediately at smaller scale. Alberta currently receives approximately $9.2 billion per year in Canada Health Transfer and Canada Social Transfer payments. On independence, that money stops. The counterpoint is straightforward arithmetic. Alberta stops sending approximately $20 billion net to Ottawa annually. It loses $9.2 billion in transfers. The first fiscal position of an independent Alberta, before touching royalty restructuring, before redesigning a single program, before anything else changes, is roughly $10 to $11 billion better than under Confederation. That is the fundamental fiscal logic of the independence case, and it's difficult to argue with on those numbers. CUSMA membership, for example, is not automatic for a new independent country. Critics treat this as a near-fatal obstacle. It's worth examining more carefully. What Alberta brings to a bilateral trade negotiation with the United States is specific and highly valuable. It is the 4th largest proven oil reserve on Earth, the largest foreign energy supplier to the U.S. market, and the country on which Midwest refineries in Ohio, Pennsylvania, and across the industrial belt are physically dependent for heavy crude that has no ready substitute. Several of those refineries cannot run on anything else at comparable economics. Alberta has already been developing its own Washington relationships. Premier Smith appeared at CSIS in March 2025, engaged directly on the tariff file throughout that year, and framed Alberta's energy position in terms that resonate directly with the current U.S. administration's energy dominance agenda. The reception has been substantially warmer than Alberta typically receives when negotiating as one voice among 14 inside the Canadian federal system. There is also a structural argument that CUSMA exclusion or renegotiation could produce a better outcome for Alberta than the existing deal. Canada's trade negotiating position is perpetually constrained by the need to protect Quebec's dairy supply management regime, Ontario's automotive sector, and a long list of regional carve-outs that have nothing to do with Alberta's interests. An independent Alberta going to Washington with a single clean proposal, guaranteed long-term energy supply, zero tariffs, stable partner, is a fundamentally different negotiation. Whether the outcome would be better is uncertain, but the argument that it would automatically be worse is not as solid as it is usually presented. Alberta has no coastline. Every export moves through another jurisdiction. BC to the west, Saskatchewan to the east, or the United States to the south. Critics present this as a structural vulnerability that makes independence non-viable. The BC trade relationship is worth examining closely because the dependency actually runs in both directions. BC exports more goods and services to Alberta than it does to China, its second largest international market. Nearly all Alberta goods destined for Asian markets are shipped through BC ports. Two-way trade between two provinces exceeds $30 billion annually. There is more interprovincial migration between BC and Alberta than between any other two provinces in Canada. An independent Alberta disrupting that trade corridor would be damaging to Alberta, but an independent Alberta that BC chose to freeze out of port access would be damaging to BC, arguably more so, given that BC's interior economy and port revenues are structurally dependent on Alberta freight volumes. Neither side can afford a blockade. This is mutual economic dependency, which any rational framework leads to a negotiated corridor agreement rather than a standoff. The Canada-Alberta MOU signed in 2025 already committed to trilateral pipeline discussions with BC, and the economic incentives for both sides to reach an agreement are clearer whether Alberta is a province or a country itself. The landlocked critique is real as a transition risk, particularly if BC negotiations become adversarial. It's not the permanent structural disqualifier it is usually presented as. So let's add it up. Economic mass, Alberta clears the bar. GDP comparable to Norway, per capita wealth above most sovereign nations, population in the range of Finland and New Zealand. The size argument against independence doesn't hold on the numbers. Resource endowment, extraordinary and underreported. Oil at world top 4 scale, natural gas at top 9 globally after the 2024 reassessment, agriculture at $23 billion in farm receipts and record export levels, critical minerals in early but promising development, freshwater access that is routinely undervalued in current analysis. Fiscal position from day one? Positive. Losing roughly $9 billion in federal transfers but retaining $20 billion in net contributions gives Alberta an immediate fiscal improvement of over $10 billion annually before any other changes. That is not a small number. Military. Manageable on a phased timeline. The NATO pathway is credible given current pressure on member states to contribute meaningfully, and Alberta's resource leverage with the United States. Not a day one solved problem, but a solvable 10-year project. Currency. Solvable in the short term through USD dollarization, which provides input cost stability through commodity cycles, as well as price stability. Monetary independence is a medium-term goal, not a launch requirement. Pensions. The asset transfer range is contested, and the negotiation would be difficult, but the structural transition, obligations follow contributors, new workers phase into the APP, is workable even at the lower end of transfer estimates. Trade. Complicated, but Alberta's leverage with the US is real and vastly underappreciated. The BC relationship is mutual dependency, not one-sided vulnerability. Now to the arguments against independence that don't dissolve under scrutiny. The legal and political path is not clean. The Supreme Court's 1998 Quebec reference established that a province can pursue independence on a clear question with clear majority, but the federal government controls the negotiating timeline and has no obligation to move quickly or generously. A determined federal government could make the transition process extremely slow and expensive. That is not a hypothetical. It is precisely what Canada's constitutional framework incentivizes. The negotiation risk is real, it should not be minimized. The oil price risk is real and not fully hedged. The entire fiscal case for independence rests heavily on resource revenues that are priced in US dollars and subject to global commodity cycles. At $100 oil, the numbers look very different than they do at $60 oil. An independent Alberta without the diversification of the broader Canadian economy is more exposed to that volatility in the transition period before the Heritage Fund reaches meaningful scale and before the agriculture and critical mineral sectors have had time to develop their full revenue potential. The USD dollarization strategy mitigates the currency amplification of this risk, but it doesn't eliminate the underlying commodity exposure, and the transition timeline is everything. A well-sequenced decade-long process with negotiated asset transfers, phased military build-out, and parallel trade deal construction is a fundamentally different proposition than a fast, contentious separation driven by political crisis. The numbers support the former. They are much harder to defend in the latter. The question we started with was whether the numbers added up. The honest answer is largely yes on a phased timeline with competent execution and at sustained resource prices. The arithmetic of an independent Alberta is not fantasy. It sits in the same range as countries the world considers stable and prosperous without a second thought. What the numbers don't resolve is whether the transition would be executed well, whether the political process would allow the orderly sequencing the fiscal case requires, or whether Albertans would ultimately decide the price is worth paying. The legal path is long, the negotiation would be hard, and commodity prices are not guaranteed. Those are real uncertainties, but they are not uncertainties about whether Alberta could sustain itself. The balance sheet taken seriously says it could. For investors, the practical near-term read is this: the independence conversation is doing real work regardless of whether it ever results in independence. Watch the Alberta pension plan negotiation. That's a test of how much fiscal autonomy Alberta can extract from Ottawa within Confederation. Watch the Tidewater pipeline file. BC port access is the single largest discount currently applied to Alberta energy assets. Watch how Alberta's direct Washington relationships develop through CUSMA renegotiation. That's a card Alberta has never held before. The most likely outcome remains a better deal within Canada rather than exit from it, but the credibility of the exit option is what creates the leverage for a better deal. And the numbers we walked through today suggest that option is considerably more credible than most people in this country assume. Well, that's your daily brief for today. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.